Fed has cut rates. Rates have been cut at last. We've been waiting for this one. Markets did mostly suspect this was happening, but over the last few weeks, there's been times when expectations of a rate cut have been super high, times when they've been super low. We've actually seen swings down from 30%. People thinking only 30% of people think there'd be a cut, right up to 90%. Let me know you can hear me in the live chat, please, and that everything is working here on my settings because I have a slightly different setup compared to normal here. And let's talk how this might affect markets. Good to see everybody in the live chat. How y'all doing out there, everybody? Let me know. It's great to be back here with you speaking about markets. BBC here's, pardon? Oh, the top of my head has been cut off by the screen. Oh, that's when you think you've got everything all perfect. Back, there we go. Right, let your friends know that we're here talking about this. We're doing a stream here, live stream. I'm Rocky Outcrop, a professional, and I'm here to help. If you're an investor or a trader, then you've probably got some trading and investing chat on your mind. I want to hear it. Put it in the live chat box. The big news of the day, of course, is that there has been a rate cut. US Central Bank says it will cut the country's key lending rate by a quarter point, 25 basis points is what they call it. It's the third reduction this year, which brings the key interest rate to 3.5 to 3.75%. If you're from the UK, you'll be wondering what's that all about. Interest rates here, the Fed talk about them in terms of ranges. So, I mean, it can be as low as 3.5% that you're getting to borrow your money in the United States right now. Woohoo. And most people, of course, watching the show, retail traders and investors, are thinking about how things like this could affect price of mortgages and the stuff that you kind of have tangible contact with daily. But there's another part to interest rate cuts, which is really huge. And it's not business to customer. Like, you might be thinking, okay, here's a shop that's selling sneakers and they want to sell more sneakers. People get better deals on credit cards. Maybe they'll come in and buy more sneakers. Good for business having lower interest rates. No. Instead, that sneaker company is thinking about how it buys its products with lines of credit from suppliers, and it's running a business which is geared, it's got leverage, it's got some debts in order to actually survive as a business. You know, cash flow, and most businesses in the world have some degree of debt. When the interest rate gets cut and these businesses that are doing business with other businesses have more cash in the bank because there's less going out paying interest every month, that is fantastic. And it's also loosens up their ability to get more credit in the future, making it so that doing business deals with each other is a bit easier. They also know that the other person on the other business is getting a great deal on their credit as well, which means that they're more likely to pay you the money that they owe you whenever you set up business deals with them. So there's a whole part of this market, the business to business market, which benefits hugely from interest rates in a right here, right now sort of a way, as opposed to business to customers who may only benefit from this, you know, down the line when they've saved $100 here and $100 there, and they start thinking about making some other discretionary purchase, but they might just find that absorbed away in things like inflation and so on. And this could be the start of something lovely here for the economy, because it's the lowest the interest rates have been in 3 years. So we're here to talk about this as the main chat for the show today. We can see how the markets have responded to it. Here's the ES1 chart. This is ES1 exclamation mark if you want to type it into your own trading view. The futures for the S&P 500. And this is the 24-hour time frame, just giving you an idea of trend to begin with before diving in any deeper. And we can see that today has been nice green 24 hours. So let's break this down a wee bit and see how it's been looking on the shorter time frames. The notice if there's anything that affected that kind of an outsized move. Did anything affect that daily performance on the chart here? We can see that there was a nice move up, bit of the old inverted BART formation. If you're a crypto trader, got a massive drop down, followed by a huge push up into a space where there was a lack of liquidity, which is a cool idea to keep in mind, because this is a concept I'll be talking about here again in about 5 minutes. When I talk about cryptocurrency. But what I'm doing right now, by the way, is looking, if you're just joining us, looking at the reaction that the markets have had to the Fed rate cuts. Yes, if you were looking at that chart and thinking there was a big outsized kind of not the average candle move, then what could it have been? And it was this preparations for the future business to business deals that are happening. Markets obviously responded quite positively to the rate cut, and we saw a move up. Now, has that continued into rip roaring, setting the heather alight type of moves into post markets and in traditional markets? Obviously, here it's electronic trading hours, extended trading hours, except cookies. Why does TradingView do that? Anyway, so here we are here looking at it in the post market, sort of getting an eye in the SPY after hours, because if we were to just look at the SPX index here, it's closed, so that's why we're on that one. And we can see that there has been a little bit of sideways into close so far. So we're still awaiting a huge move, but we've certainly seen positivity today. I think that this speaks a little bit to the markets, how there was volatility here, right, as the prices dropped down in the past, and then a period of range in sideways prices where there was lows established which were tested again a few times but not convincingly broken, followed by a huge move back up again, relative in terms of this time frame. In the big picture, it's not completely unheard of, as you can see, but a big move back up there. And that has been into this low liquidity area, and it's been a change of the character slightly, but it's not managed to take out these highs either quite yet. So we're still overall in the kind of the range when we zoom into the bigger picture. So nothing's really properly changed yet, but we've had this period of a delay sideways before coming back up, and then overall a period of delay overall in terms of the trend, and that then translates into the 24-hour time frame, as we were just looking here before, gives us the context that we're looking at. We're seeing this period of slightly sideways, and that was last couple of weeks it's been up here, not moving massively, because over here was the drop down in the expectations. Like I said, a big range of expectations about whether or not there'd be an interest rate cut. Around about this time here, there's only a 30% expectation of there being a cut, and then prices then pushed back up to these sort of areas where there was a sort of 80% expectation of a rate cut. So this is what you would then effectively call having in this area here, you could say that this is effectively has been pricing in the upcoming rate cut, right? Pricing in the rate cut. So we've seen that happen over the period of the last couple of weeks, is that the rate cut has been being priced in here. First off towards these lows where they thought there wouldn't be one, then up towards these highs where they thought that there would be one. But ultimately, it's kept us within the range of the larger period as well. So we can see that this kaleidoscope of price action is on the small time frames, represented on the larger time frames in its own way, doing the same thing when you sort of change the lens and look at a little bit higher. And what we're seeing there is a period of delayed volatility in a markets which have got relatively low liquidity. So on the one side of things, like the rate cut could help loosen up finances to add a little bit more liquidity to markets, but that's not really what I'm looking for. I'm looking for liquidity to be coming back into business operations and a bit more free cash flow, so we get better breadth in the market, and the price of the overall markets can move higher, because if we consider that these all of this is happening around all-time highs, so if you want the prices of the markets to move even higher, and not drop down to test the 200 and fill in this flash, which is obviously where the major risk lies, by the way. Not a perma bull over here. This is the bearish case, and we can talk about that if I get enough comments below this video. So put them below if you want to hear the bearish side of things. They explicitly extremely why we would possibly go there type of story. But this is actually a discussion about whether or not this operates as like a bull flag then for a move higher later on. And will we get that delayed volatility coming in if there's increased liquidity in the markets? What could give liquidity increasing in the markets? Not the rate cut itself, but the better access to cash and business to business stuff. So if we do see that happening, it's going to be the lower kind of ranked companies, the ones that have got highest exposure to debt. You know, it doesn't really matter much to PayPal what debt is, because they don't really have any. All they keep is really efficient, lower than the interest rate debt that they make money off of, and they buy back their own stock and do dividends nowadays. For example, PayPal aren't going to benefit on their own kind of balance sheet from the rate cut, for example, but some small company out there which has got debt, as most businesses do, say some company listed in the Russell 2000 in that kind of middle belly of the market, are they going to benefit? And they would benefit. So then if there's liquidity coming back into trade and invest in those stocks, if that's where the liquidity comes into markets to help, then that would be breadth in the market and be very, very bullish overall. So why is this is a distinction from why things are happening, what things are happening now. And you might be thinking, wow, you're describing the way maybe things should be, or the way maybe you might think I'm describing the way that things kind of are now. But what I'm saying is actually, this is what things could change to be, because what's been happening instead is that we have got markets full of people that have been trading it like it's 2023 in the run into Trump taking, like, potentially becoming the president with the expectation of better moves forwards in the kind of the 2024 period of the bull run, thinking that that's happening overall because the index is going up, like S&P and the NASDAQ, they're going up, and you know, you can see big headlines about big companies like Nvidia and so on, and people are trading the market overall on a very small set of stocks, giving an impression of overall growth to the wider market, which is leaving kind of us, the retail trader, at the sharp end of the stick, where all of the smaller stocks where there's good value are not getting any appreciation because it's a skewed market. So people think they've been trading one way, but actually what's been going on is this 2023 2024 trading happening in 2025, and here we are in December. It's about to turn it into January 2026, and we've now got the lowest interest rates that we've had for 3 years. So there is a fear that exists in markets that the prices of everything could go back down to this level for good reason, right? To where that flash target would be in around about 6,200, and there's good reason to have that concern. But if a new regime begins which sees values in the middle belly of the stock market rise, because there's a general feeling that the market's overall economy remains fairly buoyant, then this could be good. Because how do textbooks talk about rate cuts? Well, rate cuts happen when the textbooks say that you need to create looser capital conditions so that you can offset problems in the economy to keep things flowing and people keep their jobs and so on. You might have to make cuts. But when rates are really, really high, you're not going to make the cuts, and people start losing their jobs and so on. And that's what the data has been coming out from the Fed, has been talking about that for a long time, kind of textbook stuff. So then people see a rate cut happening and they think, oh, does this signal underlying weakness in the economy? An underlying weakness in the economy is a fear that everybody has in their lizard brain that's been invested in right now. And the answer to why that fear exists in everybody's lizard brain is, as I'm telling you, because they've been trading like it's 2023, 2024 during 2025, because Trump's been the president during 2025, and all the expectations that were built up under Sleepy Joe as the market skyrocketed were then kind of delayed, and then we did see a huge growth post-April once kind of people had got used to this kind of the new regime, but it was then concentrated in such a few stocks that people could really see that the markets had underlying weakness is what they were seeing there. And how does that strength return to the markets? Well, it would be to that middle belly of stocks, and that's how it would flip the narrative and actually could result in this being a bull flag and higher moves to the top side. That's the thesis that I'm putting out there. You might need to hear me say that all over again. So if you want to go back the 1 minute of that last summary, that's my thesis on the markets. And it started off by showing it in the smaller area, talking about the delayed volatility and the low liquidity regime, and then asking about how the liquidity could change and where it would go to and what it means, and defining the different types of liquidity, then running through the different setup and how that would affect the economy and why economists would look at it that way, and what the fear is in the markets, why it exists, and how it would be overcome. So that is cool. We've got that. And I wanted to then say, well, hey, you know, what's been front running this risk recently? And it's, of course, Bitcoin. Now, I talked a lot about how these things were moving in tandem lately, but I was very clear as well that the magnitude of the moves were very different magnitude, but they were moving together. It's like if you're on the ski slope and you're the S&P 500, you're on the baby slope and you're going down it, and you wave over and you see your dad or whatever skiing down on the adult slope, and he's going 100 miles an hour going down a bigger slope, but you both start at the same time and end at the same time, going in the same direction. And that effect of these things moving in tandem but with different magnitudes and velocity has been a very big part of the show recently, and it comes into play here with Bitcoin, and it means that you can look at it in terms of front running the rest of the market. Why? Because of the effect of that difference of magnitude and time, the magnitude here on the charts, the moves that are happening at the same time as the others. You're seeing that risk off and on in the markets currently just means exaggerated or amplified bullishness or bearishness. It isn't to do with what traditionally risk off and on mean. Traditionally, risk off and on are to do with access to capital. Markets become risk on in a way that is more as a symptom of that. You'll see ups in price, but it doesn't mean that that is what risk on is. But over the last, since kind of, you know, ChatGPT started writing every single video on YouTube that you're watching script, the word risk on now means something different. It kind of just means bullishness, but a bit amplified. Anyway, here on this chart, we get a chance to see it front running it, and it's to do with the magnitude moving, and it creates structural changes. So because Bitcoin has had the same moves but with greater magnitude, it has expressed changes with regards to its own structure in the market, right? And that structural change is front running the structural changes on the rest of the market, but the moves are happening together. So this is what gives us the ability then to then say, let's look at this to see if it front runs the market. That was quite complicated to explain it. If I were to get somebody to review this afterwards, they say, you repeated yourself an awful lot during that section, but it's because it's difficult to explain. I wanted to see that there is a circularity to the way that this works, and to put that as the mechanism for how this is actually front running, despite the fact that they're linked, right? So because one would obviously mutually exclude the other normally, but this is because there's better access to seeing the risk on, risk off sentiment here, both in terms of how it was previously, but also what it actually means when it's risk on, risk off. Because as a cut comes in from the Fed, it fundamentally means the markets are more risk on. So you want to see that expressed here with that structural changes. So I pointed out before that there was a delay when I was looking at the other charts as prices kind of went sideways to an extent following a big move down. Now this was all talked about, and you can see this is the 24-hour time frame. So what I'm looking at here is the move down, like what we were talking about with regards to S&P and NASDAQ. That's the move down, but the question mark here remains on where is the move back up. Okay, it's not happened yet. So this is what it means to say that the markets has structurally different. It's been front run here on crypto. So now we get to see if there's going to be a big move to their top side that could actually be happening with just crypto coming back up to its own range over the last while. And this is where you're going to get that extra head move on the markets.
Really good explanation. That was interesting. I was wondering why when they cut rates, typically you see.
If you want to speak, you have to speak.
Typically, you see when they cut rates that there's a reaction in the markets, and when they're cutting rates hard, there's normally a big dip, a really big dip before it starts to go up again. So I was wondering, what do you think? This concept of market breadth, that seems to be runs contrary to what we've seen normally when rates are cut, like big dips come in.
Yeah.
Because as you're saying, it's because of weakness. That's why it's there normally.
Yeah, so like because we've been able to cover up the weakness in the markets over the last year in 2025 with Nvidia, etc., pushing the overall indexes up higher, it's made everything look bullish. So people have been able to kind of come at markets looking to trade them like it was 2023, 2024 in those bullish trends, but it's not had the underlying strength. So that what bubbled up in this pot of soup is stories like AI bubbles and so on that will completely collapse the market because people recognize the weakness. So what's actually looking to happen here with the rate cut is to see that the breadth does come into the markets because that would be the difference.
I think it was genius the way that you linked that to how there was like expectations ahead of Trump's tenure, and that led to like positive moves on the markets, which then the earnings needed to catch up with that, and like how you're saying how that was recognized in the top stocks as we see it realized in the mid caps. That was really interesting.
That's the engine really that people are looking to in the markets. Like you want to see the engine in the market because it's the sort of thing that's more likely to affect your job that you have because it's highly unlikely that you're working for Nvidia. They've only got a couple hundred employees. It's amazing what they've done. Amazing with just like 250 whatever it is. But like your business, you know, which could be say you're working at the local car wash. You're looking to see how are you getting on, and it's people might come more to your car wash because they can get better deals on their credit card, but that's not really the purchase decision. It's not what really affects that business. But you're going to be able to, you know, order in your soap and whatever with better deals on your credit that you're using to and you'll be able to pay and manage your own debt well
to pay your
staff more. So like so then eventually you do see it trickle back in with people making better purchasing on this B2C business. But you do see it kind of immediately with better access to capital and the confidence that comes with it, because the guy that's sitting there and thinking to himself, you know, if we had 50 grand spare in the books right now, I would send you to that training and you would get that training. It would benefit us and I want to do that. But I can't because I don't have that 50 grand. Boom, he's got the 50 grand and he's got the confidence to then send that person and the market gets better. Yeah. It's the lowest interest rates have been in 3 years.
Yeah, which is also amazing because the reason they were high was to make up for the inflation during COVID, right?
Right, exactly. So during COVID, there was a huge stresses on the economy. The price of oil futures went to negative because they couldn't fit it anywhere, and it doesn't stop coming out the ground once you start the wells. It was that bad. And then, but the economies didn't collapse. And actually, when they did drop down, as you can see, like on the SPX chart here, when we did drop down back in COVID time, that it didn't affect the overall markets hugely, and there wasn't a period spent here of the markets going, you know, sideways for ages and thinking about how they're going to recover or anything. We look back over towards the 2007 to 8 period, you can see the huge drop down that happened, and then the period of like, you know, where there was real pain, and you might not have lost your house or whatever until over here, you know, just before things started to get better, but there was that period of pain between you didn't see that during COVID. So how was that achieved? And it was through this financial engineering that happened that then led to the knock-on effects of various things like inflation and so on. Inflation, which was dropping so much globally that Europe, for instance, was able to cut interest rates to 2%. You know, we're talking about US ones going to 3.5%. Europe's been at 2%, and Japan, you know, contemplating 0.5% interest rates. But America's had such high ones, which has affected all of your lives, right? And because at the bottom end, it cuts off all your access to credit. At the top end, the cost of living crisis coming in, so you're the one that's getting squeezed in the middle, and that's affected all your purchases and decisions and the confidence even your boss has about whether or not you'll have a job in 6 months. But what happened to where during all of this was there that period of stress? And could we say it was during 2022 to 2023 until 2023 that there was that period of stress? Yeah, the markets kind of realized that there was a dissonance between what's happened and how the world actually was affected, and there was a pullback, but it never even went below the highs of 2020 before the markets crashed down. So this high here was just before COVID. So this period of down lows, we never came down here to test versus the highs, and the market said, yeah, we've done well during that. Then this is the period of 2023 to 2024.
The
I was talking
question
about,
is the money real?
yeah, and this was then people anticipating Trump coming in and taking the baton like at the Olympics when they're running around, they pass it on to the person who runs on and takes it further. Where was periods of stress in the markets here during the actually that one bit there, we did have a correction which then became into bear market territory, and it was the real split here during April earlier in the year was about whether or not the world kind of stays crazy or if everything kind of becomes sane again. Now what happened is in that period following that was that indeed the world did seem to be sane again, and we saw markets rise, and this whole period were in this period where we went up to the all-time highs, as I said there. That was structurally concentrated so much and was covering up a weakness that occurred in the economy. So people have got fear about what really is the problem, and it kind of then lands on things like, is there a circular economy happening with AI chips and so on? An interesting part about that, just as a slight aside, was that people, want to say it's terrible because they're kind of borrowing money from each other. Like AMD give OpenAI warrants on their own stock if they buy the chips and so on. And you think, well, isn't that, awful? And then you think, but wait a minute, this is America, and they're not going to Trump and saying, can you lend us the money? They're going and giving each other. It's like they're getting financing, and where are they getting it from? They're not even going to a bank. They're getting it from like the biggest believer. There's an easy way to make that case the opposite way around and say, look, they're going to their own customers. They're saying, yeah, damn right, buddy, I'll lend you the money. And instead, and it's like, oh, I can't. That's so. There's problems with that. It's like, what problem? It's amazing,
well, it's faith.
right?
It's a question of faith, isn't it?
Yeah.
And they've got a lot of it there.
Yeah, but they're not coming to the car wash, and that's the disconnect, right? And so then to then bring that back to the breadth and the economy, why if people feel that this market is operating on vanity and insanity, what if it's supposed to be that the world has gone insane?
It's because of the lack of liquidity and the high volatility.
Yeah. So we want to see that's exactly right. Yeah. So the what's been lagging there is the overall market participation top down through the middle. And that's why these things are so positive to markets. But I mean, does it mean for the index that you don't see it drop? It doesn't. It doesn't mean that you don't. You could even see a correction here, which could affect particular stocks that are really concentrated. As that the middle belly maybe perhaps comes together, and that would be a kind of a correction of a structural correction from top to bottom. But it doesn't have to happen that way either.
Well, I like the way that you talk about that. The distribution, the probability of distribution, and how in that sense there needs to be a mean correction. That's really positive, and I think partly that's manifested in the story of volatility and liquidity, and seen when you invert VIX and look at it alongside Bitcoin, and you can really see how that low volatility environment is actually really positive for risk on assets.
Right, there's just something that's completely forgotten from. So I kind of brushed over this earlier on, and it might have sounded just like some sort of disparaging, kind of cynical comment. But the reality is that people use the word risk on and risk off like flippantly, and it doesn't really mean what it's supposed to mean anymore. But what you're talking about is exactly that, and there are definite signs of that happening. And one of the big signs, of course, is the interest rates being cut. So these risk-on ideas, and it's expressed through things like the VIX chart and looking at it with Bitcoin, and then seeing the way that the structures happened. So when I was saying before that, like because I mean for weeks it was telling people about how closely Nvidia is talking to I was talking about how closely that it was correlated with the Bitcoin chart. You can see here that the fear in markets, just like to make this clear, I've got a small inverted head and shoulder that's described this move up here. Just show people, of course, like we had this at the blows, so like calling the markets in technical analysis, very, very good. Can you apply that to larger time frames? And this expresses the underlying fear in the markets, is that it's actually something like this Head and Shoulders here. If I could draw it on, where's the Head and Shoulders button here? I never think there it is. So this is the fear that's in the market. So someone like Patrick Boyle, who's a popular YouTuber, who made a video talking about Bitcoin and stuff, and the kind of the infinite money glitch, saying that isn't it so funny that you can just set up a business that only buys and sells assets, and it's much more efficient. You don't even need to do anything. They'd call them fake businesses. I thought that's so funny, so insightful from a guy that runs a hedge fund, Anyway, obviously the kind of the fear in the markets would be that this would occur. That would give you a shock to the economy, a move down, and people would feel that coming back into the price range of last 2024. And if Nvidia was trading at $132, people would think, oh, what's happened, that big shock. But of course that would affect primarily just the concentration in the stocks. But that's that aside. But came over here to talk about how closely this was related to the way that Bitcoin is working, and then to say, well, structurally though, with what we've seen recently is this huge drop down, which has not been recovered from, so to speak, yet, if you will. And what could happen, could be that, as in the past when there's been highs followed by lows and ranges between, that you could see, as we were kind of talking about here, about a move back up into that range, as I was talking about. So without the drawings on, now if people have seen the story, they'll be able to kind of imagine that, and they'll see like a move back into this range. It isn't changing. It doesn't even change the structure here to go into new highs.
Yeah, the price regime will stay the same. You need to see further confirmation of a trend change, which might be price action making the move you said, then holding a 50% retracement.
Right. And then another part of the story over the last several weeks has been about if there's going to be a decoupling that happens. Mm-hmm. So in terms of the smaller time frames, and asking things like, oh, well, we can see that there is huge spikes down and up, and when there's low liquidity areas, the price typically kind of moves back through them again very quickly, as we've seen in all of these ones that I'm highlighting now. And could that then happen with the larger ones that we've seen over here and start to change the trend? I mean, it's an obvious kind of implication from that. But but we're also asking the question, like, does this signal to us that there's a more risk-on appetite? And until obviously you're still within the same price regime, if you're not taking out the all-time highs, made new highs, and the bigger picture. But over the period of the next month, 2 months, through to like, how do we start 2026? Could this be that sort of change? And this is the reason why I'm talking like this really does boil down to the idea that that people have been trading 2025 like it's 2023 to 2024, and they've not got used to the trauma of that. And when they then look back at 2025 and think about how that went, they'll maybe trade 2026 wrongly. And this is why it's important to have this all mapped out, framed out in advance, because you don't want to be trading 2026 like it's 2025 and wake up in 2027 and think, what happened to the year? And when do you start talking about that? In January, when you're making New Year's resolutions and thinking, oh, it'll be better, and you're losing time from next year already? Or do you kind of think about it now, plan it out, and get prepared for like a better year, and look back at 2026 and say you were one of the few people that was the smart money trading 2026 like it's 2026? And that's what the point in today's show was. And that's the kind of the underlying goal. Go in to win. In the chat, thank you so much for your $9.99 super chat to support the wonderful efforts that we put in on the show here all the time. We also had 1,000 Years of Darkness earlier on, getting involved in that as well, and just making sure that I've not missed any of them. Yeah, just the two of you guys supporting the show. You're keeping the lights on, but I might have to go over the dimmer switch and just tap it down a couple of notches. Thankfully we've got LED light bulbs, which are a lot cheaper to run than the incandescent ones used to be. My goodness. So just scraping by there with the with that. Cheers to everybody who tries to keep the lights on around here. It really does make a difference, It really does make a difference. Thinking about the cost of living. And part of the show's chat today as well has been the cost of living. And the cost of everything is so incredibly expensive. It's gone crazy everywhere. And yeah, you cannot put a price on enlightenment. That's a great phrase from Jamie. We have a bit of a price tag on enlightenment at the minute, but you get $500 off if you use the code SAVE500. Just head on over to www.technicalanalysis.school. If you're wondering, do you need to type in www to get to the URL? Then yes, you do. We're old school. We've made it that way. We've made it old school. So hitting www stands for World Wide Web, and it's the thing that people thought wouldn't change the world. And I actually want to just, I was thinking about wrapping up the show there, right? I was thinking about it, especially because the Pancake Fund is so low. What are you saying? Oh, right. Okay, cool. We could do a lips and goal. So we can say we'll do some technical analysis on lips, and that's a good idea. If you're wondering, if in the audience, if you're just tuning in for the first time, you're wondering what that is, then be aware that it is a cool, fun time, fun, small stock. It's a really micro cap thing, and it's right in that kind of tasty area of companies that could really benefit from the interest rate cut in that indirect way. So let's do some technical analysis on it and talk about that. Do that if we get to our goal. So and we'll do that, start that goal just now. And in the meantime, I thought what I would talk about was this AI bubble and the fear of it, and just kind of address a couple of the important parts about it which people may not be thinking about clearly right now. One of them is to do with power generation, right? Now, we need to make more power, and one of the fears about the growth story is that you're going to have to grow your power generation as a country just in order to grow the industry. We don't have enough power. Like, you're not going to be able to get more customers to use your AI chips if you can't even plug another one in. And there's some of those fears have been expressed so far actually already, with a couple of power stations which have not delivered to their customers some of the power that they were seeking. That's that. Some of the data centers that have got customers waiting for their computers to be online, were supposed to have been able to turn them on, literally didn't have the electricity come into the data center because they just couldn't. And they were told by the power company that was contracted to give them that electricity that they just couldn't, because they'd be turning the electricity off, in people's houses elsewhere. So they just couldn't do it. Which is cray. This is NVIDIA chart here. I'm just going to have it open in the background as we talk a little bit about this story about NVIDIA. So we've got one reason why things could go badly, which is that not enough power, right? And that's because, and what that means is, if you've not got enough power, what that means is you can't turn on your chips. Because the chips take too much power, right, to run. That's the next part of the story. Fair enough. That's one serious side to it. Right? It's just not enough power because the chips take too much power. So the whole thing will collapse. So that's what that leads to. And then it's a sophisticated, multi-layered anti-AI bubble thesis right now. So there's not just that one part. There's another part to it, which is that new chips replace old chips. And the
Time with Rocky?
Tea time with Rocky. Thanks so much for a cup of tea. Tea time with Rocky, everybody. If you don't have tea, that's fine. Have coffee. It's tea time with Rocky. So this is one of the fears, right? It's that your new chips replace the old chips. So the old chips, the old chips, they're not worth anything because you've got new chips coming along. No, seriously, they say that they're not worth anything. So why are they not worth anything? Right? And we're just going to put a nice symbolic question mark here, because this point leads to this one through the question, right? So this one here leading to this point through the question, why are these new chips better than the old chips? Why is it? The primary reason is because they use less power, right? So in order to really go full head on in the sort of AI bubble chat, you have to be able to combine these two mutually exclusive things together to say that the world is screwed, because these new chips replacing old chips is going to screw the world over, and the reason they replace them is because they use less power. And they also have to say there's not enough power, the chips take too much power, so that's going to screw the world over. And what instead you have here is a growth story that people are getting kind of wrong, and it does feel a little bit dot-com-y in the sense that, you know, there's bubbly aspects to it for sure. There's things that I would say, yeah, that's got hallmarks of it, and there is technology wise there's elements like it too, but I think if we're going to cast our minds back in time to 25 years ago to think about the run into the dot-com bubble, and people started thinking, wait a minute, maybe there's a bit of a bubble here. Why go back just 25 years? That's what I'm thinking. How about we go back and do a little journey into American history and think about the bubbles that happened back in the day in America. See, right now with the story with Nvidia, what people are concerned about with this and this together, right, this can be categorized as a concern, right? Both of these concerns, both of them, that one and that one, right, equals number 3. What is number 3? What do you call that? And that's called stranded assets, right? Stranded assets. And the greatest stranded assets story that I could think of when I challenged myself to think of this earlier on for a minute or two was in American history, right? Because they want to make it relatable to people, was less to do with the dot-com bubble that many of us lived through and remember, or the great financial crash. It's more to do with a story of stranded assets and American ingenuity. And I thought, it's the gosh darn railroads. Yeah, the Intercontinental Railroad going across the United States. One of the biggest concerns with this, if you know your history, was the stranded assets. And it wasn't just like a locomotive that got forgotten on a byline. It was entire villages and towns and cities that had grown up in this shadow of the expanding railway that completely lost out. Expected revenues didn't come, industries didn't grow up, and kind of, you know, formed the basis of what Ayn Rand had talked about in her book in many ways. Atlas Shrugged. Set up a goal. Is the goal achieved? No, it's not been started. I tried to start it. Oh, it said account error occurred. So I'll just see what start goal. Oh, my goal's live. Thanks to everybody who's been contributing so far. I'll continue story. So it formed the basis of that book Ayn Rand wrote, Atlas Shrugged, in many ways, looking at these whole communities, industries, top to bottom, completely desolated because they did or didn't have access to railroad, and the economies that grew and fail in that time were all stranded assets, whole cities stranded at a station that just didn't get the traffic any longer. It's when you think about the value destruction that happened for certain investors, really you can point that story to stranded assets. So how in back in the day, and it's easy to imagine a city that had an investment because they thought there would be a coal mine, and the coal mine just didn't have a good enough vein in it, so the whole town died around it or something like that, and think about, oh, okay, that value destruction for that investor was probably pretty significant. Whatever, easy to think of in that 1800s type of context. The modern context, what is it this is people are concerned about is the things like this gas power station. So what happens if you build a gas power station to feed this thing? And to quote like Patrick Boyle, for instance, who's big on this AI bubble, the cynical story. Now, it is easy to give the bearish story. It's easier to do that. I think in many ways I should give myself a pat on the back for trying to present any sort of like bullish story, because it's far easier to be cynical about these things. It's just the arguments write themselves. I mean, you can even just conflate things like that together. It's not a problem. Because those are real issues. So like, what happens if you book a sort of, let's just say, put it in that language, a power station for the next 20 years, and you build it and everything, and that's got a lifetime value of 30 years, say, but your chips are obsolete in 18 months. What happens there? You've got a power station that's a stranded asset. You could do that across the board on every single part of it. Like, what about your data center? You've got a data center, but it's blah blah blah, stranded asset. You're not using it. Oh, people haven't this collapsed. Oh, your chips have got more efficient. You don't need that one anymore. And it's amazing, isn't it? It's amazing. And the reason why it's so tempting to be the sort of present that cynical view is because it lets you indulge in what humans love to do more than anything else. Like, because we can convince ourselves that we love to hope, but I think we love instead to despair, because the fears are easier to identify. We know the risks, but the outcomes are actually almost inherently unpredictable, and it's why we do things. It's why you need to have faith and belief when you're investing in things. Why investments need great plans and so on, because nothing's a sure thing, but what you get out of it's amazing. And what people got out of the railroads back in the day was whole new industries that evolved and new things. And actually, one of the biggest benefits to the railway owners was the land that they had. They thought that, they'd invest in a railway because people need railways. They'll buy tickets, they'll get on the train. I'm going to buy this train company and we're going to do great. And the train company did crap, but they got a bunch of land around it. And then they were able to bring trains in there and create new cities and new things out of it too. So this same process of destruction was the process of creation. And you do it in the right way, it really, really, really works. And it's a story of American success. And what you could actually change there is, so you could take this story of stranded assets and you could change that there into understanding that what you're doing is building capacity. Because that's what the story of the American Intercontinental Railroad was. It was one of building capacity and creating opportunity. And it wasn't one of selling railroad tickets. And it's the same thing with the AI bubble story. What people are creating and building here is far, far bigger, far bigger. People need power. Another part of it, which is like takes the bravery to look at, is to think about what happened in periods of time when there were new things like new power happening. New power, what does it do? And what did they achieve with this new power? Like in New York, if you just look at the skyline and you think about the power that it took to erect those buildings, the cranes, the machinery, everything that happened as a result of being able to do a simple thing like put a steam engine together, you can see that opportunity is incredible. And if you look at places like India, where the railroad exists and connects up the country in a way that it would be very difficult to achieve in the modern world. And you think, why is it so difficult to achieve that in the modern world? Because it's created that capacity at either end. It's created that demand and that throughput of people traveling there. It's a chicken and an egg scenario. And you have to be brave to lay the goddamn egg. And when you're looking at it and you think, this egg is valuable, it better stay an egg forever, then you're missing the entire point in the chicken and the egg thing, right? That's because it has to grow into the chicken, okay? So that's the AI bubble story. It's an interesting one. There are elements of it which could, of course, have problems, but my take on it is, if we're going to look back at time, the temptation is to look back at things like 2002, 2008, and say that's the story you got to focus on. And it's an interesting one whenever we've had the biggest financial impact in the world during COVID, like that you could have imagined, with oil future prices going negative, etc., and the economy just going literally to zero. If you think for a second, like Beijing and stuff had people, like 20 million people on lockdown for months. And then, they finally go back to the factories and we start putting tariffs and everything on them. And it's like this, we've only just got our guys back in the rare earth mine, but we're not even going to sell you them. And everything gets a bit kind of political and complicated. But for a while there, the boats literally were not moving. And that was then felt during a period of 2022, and all the way through to now with the underlying weakness. So the fact that there's been extended periods of actually surprisingly positive parts of the job market and so on does make you think, well, where is the weakness? And the weakness exists in the disparity between the top performing core companies and the breadth in that middle, and I've explained it really to death here, and explained the AI bubble story using a nice look back in time at your American past, something that you should be very proud of to have, because it's great American stories of industrialness, ingenuity, and you know what, carving a space into that fog of war of the technological future. And the thing that people forget, that hell on wheels, by my word, the AI industry is absolutely hell on wheels right now, and it is a good thing. You know what is the thing is that people forget, and it's funny because you can round off the cynical bearish story by saying, and at the end of it all, when they've got this circular financing, they're going to need to have a government backstop, and that's just like, there's the Calvinist purity, the element inside me that is like, you know, a little bit old school and like a beardy Christian with a horse and cart thinks that you really shouldn't be doing stuff like that. My word. And there is a different way of there's a different way of looking at things. Hopefully we've kind of covered it in good detail in today's show, and we're going to be taking a look at LivePerson in just a second here. But the story, building capacity for the future here, is an incredible one. You're going to need the data centers. Whenever you introduced new opportunities and electricity became a thing for the first time, amazing stuff happened in the world. Chuck gasoline in there, look at the way the world transformed. And yeah, you know, there was elements that were difficult about the change, but we create new worlds, and it's an amazing thing that we're doing here. So what's the problem with an American backstop? Is to say, from the cynical point of view, is like they're going to need it, like type of idea, because they're going to be going so bust. And then let's just take a step back and look at what's happening. Moore's law, which was set out by a guy ages ago who talked about the speed of computing efficiency increasing, doubling every 18 months. That's Moore's law, isn't it? It was right for about 20, 30 years. It seemed to be like on schedule. The computers, 18 months later, the chips would be twice as fast as the ones that were there just 18 months before. Then we got to a period of time like 2010 to 2022 or something like that, where it was like the austerity Tory government style computer chip speed increasing, because it was much more like 2 years that it was happening. Moore's law is slowing down. And then what's happened since is that America has decided that it wants to be number one in AI, and it's told you all about it, and you voted for it, and you're aware of it. It's very democratic process, really headline manifesto. America said, we want to be number one for AI as a country. We're going to do this. We're going to do this, right? And yeah, that may involve having a government backstop, but what's happened is it's created a growth in the speed of the chips, which is now faster than 18 months. It's going at double every 12 months. Right? It's faster than Moore's law, and it's NVIDIA are pushing ahead. Why would they do that? Distribution companies, go and listen to an earnings call from a logistics company, and the earnings call from a logistics company, the guy on there, if he's any way decent CEO, will say, you know, we've got 100 vans on the road, and any given time we'll put out, 75 of them, and and they're like, well, why do you not use the other 25? Like, well, we don't want to have too much supply in the market, because then people will start paying less. Well, we're not going to let them have that supply. We're going to restrict supply. If you look at like the diamond mines and how they make so many millions of dollars, like they restrict supply, you're creating this scarcity. And why would NVIDIA just not keep selling the chips? Just slow it down a little bit, guys. We've got this in our back pockets. Is it because they've got a fear, like in a capitalist way, of some existential threat that this company is kind of catch up right behind them? No, don't be stupid. Sorry, it's not like that. They're not scared of it in that way. The way it's happening is the same way that China owned us, owned the world in the electric vehicle space. China's electric vehicles, right? Amazing. Joe Biden had to spend his entire presidency being like, oh, we're putting tariffs on your electric vehicles and stuff, and like 100% tariffs. That was Joe Biden doing that, right? Before Trump, yes, that's the other guy, the tired one apparently. He was putting 100% tariffs on the Chinese vehicles and stuff like that. Why? Because they were saying, well, the Chinese government has just put all this money into making Chinese electric vehicles, and they completely own the shit out of our ones. And I've invested in, well, I didn't say I've invested in Rivian, but a lot of people in the audience had invested in Rivian, and it sucks balls. Right? And why does it suck balls? Because the Chinese ones are 10 times flipping better. Like they beat Okay, Tesla is winning, so we get to say, "Oh, you're still flying the flag. We're the best EV manufacturers in the world." It's like, okay, you got Tesla at the top, which is like actually not really the top. It's like it's. But anyway, let's just put it there for fun. And then every other company, right down to like 90, is the Chinese ones, and Tesla isn't actually at the top. So, like, because BYD, for example, would be, and they also make like $12 mobile telephones. But like, they can do anything. These Chinese guys, the same company, BYD does. They make a washing machine. You can go to now that's a threat, and it was a massive threat to the American economy. It's the biggest existential threat to Tesla as a company, to the richest guy in the world. The biggest existential threat to his biggest business thing is China having got to that number one position. And America is doing it with AI, and it's resulting in the AI speed doubling. And then you're going to have people potentially even from Dublin in Ireland, maybe perhaps even going onto YouTube channels and saying things like, "Oh, it's a big crash coming," and every other economist in the world is saying the same thing. And it's an interesting one when you look at it and say, "Well, what's really actually going on here? Really, what's going on?" And there will be a problem for like some Chinese vehicle manufacturers in the future, like BYD and Xiaomi, if they don't continue to get huge growth and have massive major success and be amazingly successful companies, there will be a problem in the future. But isn't that period in between where you're like, the whole being really hugely successful for like a long period of time count for nothing? I think it does. It certainly used to count for something. So I think it still does, and that is the chat. That's the chat with the AI story. I think it's more like the intercontinental east to west coasty thing railroad. Let's take a look at LPSN because we made it to the goal, and I'll give a big shout out to everybody that put in comments when we get to the comments bit of the show, which is coming up shortly. There's a flash down here at 488. Would it be worried if it got down there and took it out? Not at all. Is this one of the companies that I think can benefit from this? Yes. You're going to say, Rocky, they don't have debt that's got floating interest rate attachment to it. Don't say that. This doesn't benefit them at all. Their interest is fixed at fixed rate. It's being paid in payment in kind in stock to their. That doesn't benefit them. And I would say, what about the company that they're selling to? Because the price of LivePerson services is like peanuts, right? So let's call it $1 million if you want to be treated like a god by LivePerson. They're like, well, what do you want? We'll give you anything. And how much of it do you want? You have it unlimited, all of it. We'll do it all. All right, $1 million. That'll get you that. So that's not much money. And how much debt do they need to have? Well, some of these companies got like billions of dollars of debt that they're selling to. I'm not being hyperbolic. Their customers are big customers who have like billions of dollars of debt. Just to reiterate that in the not throwaway sentence, that's actually the case. And the idea of them saying, "Well, hey, do you want $1 million worth of services?" And they're like, "Well, that's cool. You know, we're saving $12 million a year now, actually, as a result of that interest rate cut. We'll give you, we'll buy that for $1 million." Or they make it the package that's $500,000. I don't know. Average customer value at LivePerson is around 660 grand though. So maybe they'll give it about that. The what I'm looking at here is, yeah, potential who'd come down and test this stuff. I'm not bothered about that. What I'm more bothered about is whether or not we'll start seeing an actual change in the trend. Right now, the upward curve on the 50 simple is positive. Let's just take this kind of upward curve. You can see you kind of more or less got it there, and compare it to the 50 simple going back the way for a long time now. Let's go. This is a 4-hour chart if you're wondering. And I mean, while this is a little bit of a pantomime demonstration at this point, you can see that the 50 simple has not looked that way for some time. We can find a similar looking curve on it at $15. Somebody out there might actually try and disparage what I just did there and say that it wasn't actually real technical analysis, despite the fact that it was a really creative way of doing real technical analysis there. And so that's pretty cool. I'm pretty pleased to see that things have been managing to be stabilized in this region. I think that LivePerson, there is an onus on them to when I say onus, by the way, I mean, I don't mean it like a real kind of actual like God objective and your responsibility. I'm saying because of the way the markets are right now, low liquidity and delayed volatility, that the kind of the onus falls to LivePerson to, if they want to change the narrative and the story about this, to produce the results themselves. So I am hoping and kind of looking for, expecting is the wrong word, that LivePerson will have continued to stabilize their revenues and so on in this area and produce good quarterly reports, growing on previous ones, and we'll even get to a point where we'll say that is growth year over year, because the worst would be well behind us. And the signs coming from them right now are along those lines. So that's good. As for the technical analysis, like I say, the trend change there is possible. If we did go back down there structurally, that changes nothing. Overall, so long as we kind of stay above these lows, then you would be able to say, oh, the bottom's in. But I'm not looking for like the bottom to be in. I'm looking for a trend that really does trend up the way and gives us a couple of like major milestone targets. Obviously $15 being the big major milestone target for us. We're coming in more or less where this downward sloping trend line is now. I mean, if it wanted to go there in the near term, then that would simply just be yet another test of what has been tested several times in the past. Does it do that before or after? I don't know, but I do think that I do think there's a seriously good chance of it being able to reverse the trend when it does break this trend line. And if that had to happen, that it broke the trend line before it broke $15, say for example it happened over here in April of 2026 and it got to $13 then and then finally got past like $15 say in June or something like that, and it managed to break this downward sloping trend line that we've got kind of on the go here, that would be totally fine and for me. But just to make the sort of casual point just now, that if it did go up to where the trend line is now, that would be pretty close to that $13. You can see it's $13.50 is where the 200 simple moving average is there, so it could get up towards that $15 region. That would be kind of cool. But how would it do that from here? Like, have we seen enough? We've had this delayed volatility and low liquidity and delayed volatility regime, and it shows on the RSI more than ever. RSI directly measures magnitude of moves, so it's a good job that I was talking about magnitude so often earlier on. And that does show that there is, of course, bullish divergence in here at these lows. So there's like flagging no momentum. It's not able to push down with the same magnitude that it was before. So you go out and you're a young man, you can drink 10 pints, that's great. Then you get a bit older and you go out and you can only drink 7 or 8, 6 pints. And then it gets to the point where you can only drink 3 and you think to yourself, I don't even know if I want to go out anymore. That's what it's like if the magnitude of the move to the downside is no longer enough to have a kind of measurable difference, especially if it's decreasing, then the risk and reward is obviously being concatenated, and that is a good sign. And that's what bullish divergence really is saying to us. This period is sideways positive for a lot of reasons. That's the 2-day time frame. If you're wondering, go to the 1-day time frame, you'll see it is bullish divergence. But looking at the classic, just quite obvious there. But just looking at it from a broader point of view, to make the point that this area of sideways is being fine by me, overall, as the period of the markets are kind of put the onus back onto LivePerson to try and be the ones to make the difference, and that because of the regime that we're in at the minute of low liquidity and high volatility. Liquidity coming back into markets could affect the underlying business case for LivePerson, which gives them a better chance of doing what I said they might want to have to kind of sort of want to maybe need to do, which would be that to kind of produce their data to show that they're having that turnaround. So that's good. It's a tailwind. Does it change the story for them? No, it doesn't. They still got to do the work, sell the darn product and all that, get in there, make the sale, do the work. It's not a case of just having something that generates money on its own. They do the gosh darn work and they get the rewards, and that's what I'm looking to see, if they can get some rewards for it, and hopefully it's just slightly easier for them to do so. Kind of bearing in mind, these highs that was tested here recently did feel about right there. You're getting the volatility taking up towards 550 and back down below $5 again, giving you that 10% kind of swings on what's a relatively small looking set of candles is volatility exists there, trading's happening, but it's structurally it's not taking out the kind of the highs just there. You can see that there was this value area where the shorts came in at. Fair enough, right? People who are kind of watching this show and stuff like that, possibly those types of people would be perhaps taking punts on this thing. I don't know, but that area was kind of the one that was fairly obvious there, and it puts it so the eyeballs are back on that, obviously, for if we can see the prices beating that area. Let's give it a kind of weird looking face looking at the thing. So if we can see prices beating that area, then structurally it's changed. This is so far been positive, again, like we can see here in the 4-hour time frame, that here into after hours and stuff, positive for LivePerson, currently trading at 527, having had lows in the day of $5.08. So it's doing well. But what it needs to do, of course, is get above that. But the reason I'm talking about that is because of the structure that's here, right? So all those drawings that I've got on the charts just there and the story behind them don't need to be displayed in that way. Instead, what we'll do is we'll put a nice little colored box in there and show you what is the liquidity type of zone to be in this region. And I'm going to do it by taking this low here, right, for that wick. We're going to go up to the wick of that high and go across. And I'm going to make this visible. I think that's important. Style. A nice visible color. The background. Green. Okay, so that area there is important. Now you could say I should have used this down below. I don't think that that's relevant. It's the volatility was suggestive of the moves to come back then with this wick that went down. This is talking about the wick in November 10th that took prices down to $5. And the reason I've got my box drawn in from about 520 is because I'm talking about what were the flipping kind of liquidity happened at. Yes, this wick down was suggestive of what was to come, and we did see prices then test it again with another wick straight afterwards, or not straight afterwards, but 1 week after, on the 17th of November, before continuing to those lows. It's not relevant to this liquidity zone. It's between those lows here and this high where it failed to push up afterwards, and this is the zone that needs to be broken. So I'm going to leave that on the charts now. I've explained why it's there in a bit more detail than I would normally do, and I've also explained that movements down to 488 are to be expected. Not to be expected. Oh my gosh, that's absolutely not what I meant to say there. What I meant to say is that they're not anomalous. It's just the structure, given the impulsive move that's happened up during December, that it might leave market makers and so on the downside needing to satisfy some liquidity now that, and square off their books. So they would be disinclined to trade against prices moving towards that direction if they didn't have to, given that they got an accounting balance sheet risk here, which is so not really that important in the current maths of the thing, given that we just had the interest rates changed, looking to try and see if you can beat this price to then move higher. And at lows, it's totally fine, just as it is at extreme highs, to leave a flash on there as what happens in the markets when the market makers have decided, we've made so much on this that to try and artificially go for these lows here ourselves is no longer representing the same amount of risk and reward as what it was before, which is why I said about the RSI and the magnitude of the moves. It's no longer doing that, and a move from $5.27 to 488 is neither here nor there, which is why on the one hand I'm not bothered about doing it, and on the other hand I'm not bothered about leaving it on there forever if, as a market maker, having made a ton of cash from it going down from 15 to 447 at the lows. So it's not like that, and they might have also been delta hedging against further moves down at that point and looking to shake out their own books and move towards topside. There's plenty of other ones on here, and there's a massive flash that's like on the same time frame up there at $535, representing the point that I would actually quite like to see this one stay on here longer term, but I'm so ambivalent about it, and I think I got that message across fairly clearly there. The things I'm looking towards are about 545, and of course I'm ambivalent again, like I said, about the 520 area. And the reason this box exists on here is to give us an idea for any outcome, any eventuality with regards to the price action, this is a couple of examples. It could test highs of it, could move below it, could come back in and hit off the middle and go above and come back down and find support inside it. That the actual any of that is completely is moot to the point I've been making in the show today. So that's the technical analysis that I'm giving on it at the moment, and it's to do with the downward momentum having a little bit of a change in its magnitude, which is changing the risk and reward, and the result of that has been a period of some sideways, which is it's kind of what's happening in markets that have currently got an endemic issue of delayed volatility with low liquidity, and this what you see there as then the moving average itself starts to represent that, because it's an outcome from that fact that price action that's happened that I'm describing. So it's showing that truth there in the charts, and we've seen that it's coming towards this area. If it needs to collect more, then this could be representative of a phase of accumulation in the markets. Obviously there is the danger of moves towards the downside. You've got another box here on the charts showing you just the same sort of thing from in the past, but like I say, the price follows price, or it'll follow some other catalyst, and the catalyst coming from price itself is not happened yet, which leaves the ball in the court, or the onus with the company. But typically speaking, could it be that price leads the way? Absolutely could, and then a delay on that side isn't bad. It just means that there's becomes a narrative to support those moves. So any impulse up beforehand is great to have the follow through with positive news on. So over the period of the following months, that's absolutely what I'll be looking for. Is it out of the woods yet? No. And it becomes a slightly different story if it gets into this range. By the way, this just describes a range around about here, and taking out this box up above, which is a bigger time frame one of these, is when you can start to say, okay, we've got a high that's taken out a former prior lower high. So that's a 4-hour time frame. Put that box above into context. Here's the 24-hour time frame, and you can see this is the area that really needs to flip up the ways for you to start targeting those zones. So the story that I've been describing is, of course, as I say, this range and moving back in towards it, and then the dominoes start to fall. The trend then gets in place when you see moves that have got, of course, highs and lows like this. And Jamie was talking about this the other day, telling me about how he wanted to see things like this on the charts and educating me on this. Big hats off to Jamie for giving me heads up on this analysis in advance, and a big heads up to the people who have been doing fan funding throughout today's show. I'm going to check my Streamlabs to make sure I haven't missed any donations. Let's just do that first, because that'll be easy. 23 minutes ago, no, there's no donations that have been missed there, just super chats. And then that's then back over to the screen, so see super chats. And a big thank you to these folks here. Earlier on we had the show start off with 1,000 Years of Darkness and go in there, then we talked about the goal, and we got these messages. The electricity bill doesn't pay itself. That's some good one. Cheers for that, Disco Biscuits. Jay Hunter was saying happy belated birthday. Cheers, man. It's always good. It's good to celebrate. It's going to be the decade of success for all of us. Get on board, hit the like button and all that stuff to everybody. Looking forward to it. So cheers for the birthday messages. I can't see a goal, but I'm down. Right, sweet. That was Dashi getting involved in the party for the goal early. Thanks so much. And we also had 1,000 Years of Darkness, Nick, and Crazy Pitta. Japney got involved as well. Cheers for the compliment. And Nick getting back in there again, executive user, and 1,000 Years of Darkness and Nick really being the momentum in that ride to the chat. I hope that you like to the success to getting through the goal. Bad Mama Jama just dropping 5 outcrop memberships to people. Sweet. Purpley Perps, Buster Hoonahan, Careless Whisper, SNHP6ZB. This guy's named himself after a printer or something like that. And Bluegill 300. You're new members here. That's brilliant. Check out the content on the channel. It's been fun. It's been a hell of a good time. It's been a great show. Thanks to Jimmy for coming involved and getting involved in that Q&A section we did halfway through. You're welcome. Thanks so much. And thanks everybody for being really just what I like to see in the world, which is people making a rising tide, you know, a rising tide, making everybody better. You demand a lot from me. I demand a lot from you. And together we have each other's backs and we just push on a greater and better successes all the time, and we give each other that motivation. So appreciate to everybody who does that. See you all again